Hey everybody, Smart Silver Stacker here. Hope you're doing well. Today we need to talk about China because China just pulled out the stimulus bazooka, the biggest rate cut of its type in their history. And what we are witnessing here is a fiat currency race to the bottom that began last week when Jerome Powell at the Federal Reserve announced a 50 basis point rate cut to the federal funds rate. Now, that size of rate cut in the past has been reserved for periods of economic crisis. What we're hearing from the political elites and the central bankers is that the U.S. economy has never been stronger. But if that's the case, then why are there now signs that at the next Fed meeting, we may get another 50 basis point rate cut? Well, the reason is because there's a lot of problems in the U.S. economy, not the least of which is the fact that the interest on the national debt now exceeds $1 trillion. And what we can expect to see from here out is more inflation, more currency debasement. Those inflationary effects are already working their way through the economy. That's probably why yesterday we saw another record all-time high in gold, and also silver had its highest daily close in over a decade. But what we're witnessing right now in the gold and silver price is just the beginning. Because in a fiat currency race to the bottom, like the one that just started, the real winners will be gold and silver. That's what we'll talk about in today's video, so stick around and let's get to it. I want to say a big thank you for tuning into today's video. If you enjoy it and you get some value from it, please do give it a big thumbs up down below. And while you're at it, why not subscribe to the channel? Did you know SD Bullion is giving away a monster box of 2024 Tree of Life silver coins? Sign up today at sdbullion.com/sweepstakes. Okay, so yesterday China did pull out the stimulus bazooka. They announced the biggest cut in history to its one-year policy rate. The reason that they're doing this is to pull their economy back from the brink of a deflationary death spiral. The reality is that the Chinese economy, much like the US economy, is addicted to easy money and further debt creation to stimulate growth. In fact, this is a worldwide phenomenon. Now, around the world, governments are $91 trillion in debt. And that's why we are going to witness a global fiat currency race to the bottom. Now, here in the US, just last week, we got a 50 basis point rate cut to the federal funds rate from Jerome Powell. But now, according to the CME FedWatch tool, markets are anticipating another disproportionately large rate cut at the Fed's November FOMC meeting. It's important to reiterate that cuts of 50 basis points in the past have traditionally been reserved for periods of economic crisis. During quote-unquote normal times, the Fed has opted for 25 basis point moves. So they know that they need to stimulate the economy here in the US and that we are facing a massive economic crisis. We're just not being told. A major component of that is the fact that the interest on the U.S. national debt is absolutely exploding right now. We are on track to hit $1.2 trillion in interest on the national debt in this fiscal year. And this infographic from Visual Capitalist illustrates nicely the exponential manner in which the interest on the U.S. national debt is exploding. You can see that following the 2020 pandemic, it has been a near vertical increase in interest, and without significant cuts from the Federal Reserve, this number is going to continue to explode. In fact, if you ask me, this number indicates that we are already past the point of no return, and that ultimately we are on a path where the Federal Reserve will be forced to monetize large portions, if not the entire U.S. national debt, as this fiat currency race to the bottom enters its terminal phase. But we're not there yet. And we're already beginning to see the inflationary effects of declining interest rates in the U.S. Just today, new home sales for August were reported down 4.7% from the previous month, but on an annual basis, the number was actually up 9.8%. This can be attributed to the fact that mortgage rates in the U.S. have been on the decline since May of this year, coming down quite significantly. And now that the Fed has embarked on their program of rate cuts, this number will be coming down much lower, but we're already beginning to see inflationary effects and a pickup in the velocity of money throughout the economy. Another sign that we are in for some major inflationary effects here is the big wave of refinancing, which has kicked off as these rates come down. Now, why is this so inflationary? Well, this is people treating their homes like a piggy bank. This is in part what led to the great financial crisis, was the wealth effect, right? The increase in asset valuations due to low interest rates, and that triggering a bunch of cash sloshing around the system. Now, if you want to understand why this is inflationary, people increasing their borrowing against an asset like their home, for many people, their most valuable asset, we just have to look at the original definition of the word inflation. In today's dictionaries, inflation is just defined as rising prices, but the original definition, which you can find in dictionaries from the year 1971 or so and earlier, and it's interesting that that's when the fiat currency race to the bottom really kicked off, as President Richard Nixon ended the convertibility of the dollar into gold. But if we look at this original definition, it defines inflation as a sharp increase in the amount of money and credit causing advances in the price level. And a wave of refinancing of homes is an increase in the level of credit. This is just getting started, especially if we're going to see multiple 50 basis point rate cuts by the Fed. That is going to stimulate a very sharp rise, not only in the level of money, but also in the level of credit. And it makes sense when it comes to inflation. It doesn't matter if it is cash that someone is paying with, or if it is borrowed money being created out of nothing. It's still currency that is chasing a fixed supply of goods and services. And so when you inflate the level of money and you inflate the level of credit, it drives prices higher. Speaking of prices going higher, we should probably take a look at the price of gold and silver, because the gold price yesterday hit yet another record all-time high, closing at a price of $2,657. It's interesting. There were some banks and forecasters saying that we might see 2,700 gold by the end of 2025. And now it looks like we may see it by the end of next week. And you can see just day after day, new record all-time highs in the price of gold. And it's a similar story in silver. We're not breaking out to new record all-time highs, but yesterday, silver closed at $32.08. Now that is notable because that is the highest closing price for spot silver in over a decade. Now, to be fair, not by much. It was back in May of this year, May 28th to be specific, that silver spot closed at $32.07. But we did exceed that level with yesterday's close. A slight pullback in the price of gold and silver today. Silver's down about 1%. Gold is basically flat on the day. But for me personally, I will view any declines at this point as simply opportunities to get into these markets, because central banks around the world are making it clear that further currency debasement is the name of the game. And if you ask me, it won't be long before we see the silver price hitting new all-time record highs, just as we are witnessing in gold. One indication that gold and silver still have much more to run is if we examine previous highs in inflation-adjusted terms. So SD Bullion actually has an archive of daily gold and silver prices dating back multiple decades. And here you can see that on January 21st, 1980, gold closed at $850 an ounce. Now, if we use a CPI calculator provided by the Bureau of Labor Statistics, you can see that $850 in January of 1980 is equivalent to over $3,400 of today's dollars. So while gold is breaking out to record all-time highs right now, it is still not anywhere near its inflation-adjusted all-time high. And in silver, it's even more extreme. Here you can see that on January 18th, 1980, silver closed at $49.45 per ounce. Now, if we adjust that previous silver price all-time high for inflation, you can see that in today's dollars, that would be over $200. So despite the fact that gold and silver have been putting on significant gains recently, yesterday, silver was up over 5%. They both still have a long way to run to take out previous highs. And given the stage that we are at in this currency debasement and what we're hearing from central banks, that is coming. And I want to get prepared ahead of time by having as many physical assets on hand as possible. Leave me a comment down below to let me know what you think about the topics we covered in today's video. Thanks for watching, everybody. Stay safe and happy stacking. I will catch you next time. Smart Silver Stacker, out.